So today's Cardinal lesson, we're talking about a long-term care annuity that is an annuity contract that pays for long-term care. It's really designed to have long-term care benefits. Like if you didn't want the long-term care benefits, but you were interested in an annuity and the tax deferral and the future payments and future income, you wouldn't buy this particular annuity because this is really all designed around long-term care. So just understand that this has all the characteristics of any other annuity we talk about. But when you start seeing the long-term care benefits on this and the availability of them to some people that possibly have some health conditions that couldn't otherwise get it, you're going to see why I'm so excited about this. So I want to go to Tom, and I want Tom to talk about, so why are we doing this video today? What's going on here, Tom?
Yeah, I mean, this video is really for the people who maybe have been told or think they're uninsurable for long-term care. This policy is potentially is available for you. So it's not everyone can qualify, but a lot of people who would be turned down elsewhere are able to qualify for this. And so it's really exciting for us because we can now help people that in the past we haven't been able to help. And so I want to bring up the show notes here. You can find these at the link below the video. They're also on our website. I'm going to just scroll through real quickly because it's going to be pretty confusing if you just started on the illustration. But we have the board, we have the illustration. So we're going to hit the key points on the board here. There's a lot of details in this document. So watch the video first before you try to go figure out this document and then go back, and it will make a little more sense. But if you want to see the actual numbers that are supported on the board, here is the illustration. I will point out this is for a 65-year-old person, who's putting 100,000 in. If these numbers are different, the benefits will obviously be different. But that's what we've illustrated here. So I'll turn it back to Hans, and we'll just get going on the board here.
Okay, so to try to simplify and summarize, I mean, for starters, we're using 100 grand or $100,000 deposit because it's pretty easy to move it up and down. We've had several people where we've explained this to them using a $100,000 example, and then they've chosen to put 75 grand in it instead of 100. We've also had people who started at 100 grand, and once they saw all the benefits, they put 175 grand in it. I think you can put up to like 500,000, but that's going to buy such high long-term care benefits that I don't really see us doing one of those. But so why would somebody stick $100,000 in this thing? Well, for starters, there's a whole class of people who are not eligible for another product which you might perceive as better, where you could put $100,000 in there, or buying long-term care where you pay by the month or by the year. They're not eligible for that, and they might make it through the underwriting for this. So there's all kinds of reasons that people would use it. And what I'm going to explain to you is if you use the 100,000 on a male age 65, is at the end of the 5th year, you're going to be age 70. Your long-term care benefit base is going to be guaranteed $347,000, and your monthly benefit for long-term care is going to be $57.96. And then the non-guaranteed basis here, the only difference between guaranteed and non-guaranteed is the performance of the underlying annuity, and it's just slightly more. But it's almost 360,000 and almost 6,000 a month of benefits, and the monthly benefit will be paid out for 60 months or 5 years. It's also paid out as an indemnity, so you don't have to send in receipts. You just have to qualify for the long-term care benefit. And once you do, and you have to prove about once a year, every couple of years, that you still need it, they're just sending out checks, which, as you can see, those checks are going to add up to substantially more than the long-term care, than the 100,000 that you put in the thing over time. Now, so why do I start with the 5th year? Because there's a phase-in benefit. Like if you use it in the first year, you only get 20% of the benefit. If you use it in the second year, 40%, and so on and so forth. And it gets to be the 5th year where it pays out 100% of the benefit. So the insurance company needs to protect themselves a little bit from somebody buying it, sticking 100 grand in there, and turning right around and beginning to collect 300 and some thousand dollars. So in any case, this is also showing what your benefit grows to 5 years, 10 years, 15 years, and 20 years.
I want to make one point on that. That benefit base, that is the total amount of money that they potentially will pay out for long-term care. If you use it for the full 60 months, and, you started at age 70, you're going to get $347,000 out of that policy. You've only put 100,000 in. So it's a really nice way to get some extra money, to get the leverage from the insurance company to have much more money to pay for that care than you otherwise would be able to do so.
Yeah. And so, I mean, what you're going to be thinking about if you're actually using this is you're going to know that you're getting almost $6,000 a month. I mean, it's coming in every month. And then you're also going to know that when 5 years pass, you've used it up. But this is what people are focused on when they're in a claim. Okay. And so I don't want to dwell too much on that, because if you're interested in this thing, we'll sit down, we'll run you an illustration based on your age, your gender, and the amount of money you think you want to put in here. Now, I also want to make a point is you can't use IRA money in this policy. The benefits come out of this, and I'll talk about that in a minute, are tax-free. So just understand this $100,000 deposit or premium payment needs to be out of after-tax money or out of savings. So now, if you only have part of that right away, they'll let you add premium for the whole first year. So in other words, if you put in 50,000 that you say you're going to put in right from the beginning, and then you can have a plan to stick another 50,000 in there within the first year, you'll end up with a very similar benefit. So, like I said, this video could go on for hours if we talked about every one of the intricacy. We just want to give you, the nuts and bolts of why we're talking about this. Now, I do want to go to the end, because we always have to go over this, is there's 7 states where this product is not approved yet, okay? And 6 months ago, there were 30 states that this product was not approved in. So they keep adding them. But as we stand right now in March of 2024, it's not available in California, Connecticut, Indiana, Maryland, Massachusetts, New York, or Virginia. Now, understand, we have other annuity products in a lot of these states that have more simplified underwriting. And we certainly have life products. So this is just this one product with this one company, is not in those 7 states. And, if you're watching this video down the road, some of those states might come in the picture. So we understand that. The product includes a personalized wellness program. If you choose to engage with it, you don't have to engage. They charge you within all these numbers $100 a year. And so you get going with this program. You set up along with the coordinator a personalized fitness program or wellness program. And then as you execute on that, you get bonus points or you get extra long-term care benefits. So in other words, they're incentivizing you to live a healthy lifestyle. And you have a say-so in the program that's set up for you. So I don't want to spend too much time on that, but that's there so you could increase these benefits. We have a simple qualification. So when we do the qualification, what this company has taken a different view of who they take and who they don't take. Okay. And, we've joked a few times with the general long-term care companies, if we send a picture in of some of these people, or the company was able to interview them in person, they might not issue the policy, because there's some people that look really good on paper, health-wise, but yet when you spend some time with them, you can really understand that there's something else going on there. Well, this company has figured that they can eliminate, or they can pick out the people who are the cause of the 2 biggest areas where claims start. One is memory. So you're going to get, if you apply for this policy, you're going to go through a delayed recall memory test, which is a scientific thing that can identify somebody who has early memory loss. And it's repeating a bunch of words, but it's scientific. I've used that, or companies have used that for years. And then the second thing they're going to do is you're going to have a straight back chair. You're going to have to do it over Zoom. can't have wheels on it, can't have arm sides on it, and you're going to get up and down out of that chair a number of times. I mean, not like 20 times or something, but you're going to get up, you're going to get down, you're going to get up, and they're going to watch you. And so they're identifying people that have a weak gait, that, that are a fall risk. And so before we even set up the interview, we use these 5 screening questions. And I'm going to let Tom read through those. And these are people, if you answer these questions yes, you're still eligible for these policies, but it's at much less benefits than this. So we're presenting this whole video in such a way that there are people going after the maximum benefit or the next one down. So I'd like to bring Tom on, and I'd like Tom to just, as he would with somebody that's interested in this, just read the questions.
Yeah, and I think you made a good point there. Is they have 3 underwriting classes for this policy. They have a preferred rate, a standard rate, and a secure rate. The preferred rate is what we've illustrated here in the illustration. So even if you answer to yes to some of these, you might not get the preferred rate, but you might get that standard rate, which is still a pretty good benefit. So just know that this is in the secure rate. I guess I said you might be eligible. I guess everyone is eligible for this policy. Maybe not at the benefits we've illustrated here, but if you have some of these questions and you get the secure rate, they still take you. You just don't get quite as much benefit. So here's the 5 questions. Do you currently live and receive care in or use, have applied to, or been advised to reside in a nursing home, assisted living facility, any other residential care facility, home health care, or adult daycare? So essentially, are you needing care right now, or have you been advised to need care? So that's question 1. Question 2, do you currently need any assistance or supervision in performing any of the following activities of daily living? Bathing, dressing, eating, walking, moving in or out of a bed or a chair, toileting, and or bowel or bladder control. So if you're familiar with this at all, those are the 6 activities of daily living. They just essentially want to know, like, do you currently need help with any of those 6 right now? Question number 3 is, do you currently use a wheelchair, motorized scooter, stair lift, hover lift, or respirator? So interestingly, Hans could actually answer no to that, even though he's got this cane he's walking around with right now. But that's what essentially, are you in a wheelchair? Can you not be able to move around? So that's question 4. Question 5, have you ever been diagnosed or advised by a member of the medical profession as having or been treated for any of the following conditions in the past 5 years? So that's a key point there. This is in the last 5 years. So if you had something 10 years ago, the answer would be no here. Heart attack, bypass angioplasty, stent surgery of the heart or legs, COPD, chronic kidney failure, cancer of the bone, esophagus, liver, lung, ovary, pancreas, stomach, uterus, lymphoma, leukemia, or metastatic cancer. So it asks about certain types of cancer. It's not all types of cancer, but they are looking for specific ones within the past 5 years. And then the last question, in the past 5 years, have you received Social Security disability insurance benefits? Those are the 5 medical questions they ask. Once you make it through that, then it's like Hans was saying, is they do the memory test where it's on Zoom, where they're asking you a bunch of questions. You got to repeat back the words and that kind of things. And then it's the mobility. They might have you stand up and down out of a chair. I've had some people have this, like, walk heel to toe and, across the room. I mean, they have all sorts of different tests that they run. But if you can do all that, even if you have something in your medical records that other companies wouldn't take, you might be eligible for this policy. Like Hans was saying, you cannot use IRA money, so that's somewhat limiting. And this is also a single policy. You can't buy this on a couple. So if we have spouses who want this policy, they have to buy their own individual policy. So those are some of the limitations there. But this is just really unique that we have people who really want long-term care. They've looked at it. We've gone through the whole process. They might even have been turned down from another company. They still might be eligible for this policy.
So I'll give you some examples. The first person that we got approved on this at the preferred level had a hole repaired on his heart like 2.5 years before he applied. And he bought other insurance from us. And I mean, we said, well, we're going to give it a shot. We showed him all this, and he was just elated. He flew right through. And I could tell over the Zoom, this guy works out regularly. He's always in kind of a warm-up suit, looks like he'd wear to the gym. He passed the test with flying colors, even though he had some of that stuff in that medical question thing. We just got a guy approved with early Parkinson's, and I'm thinking that, man, there's no way they're going to take this. But I read every word, and I just went back and read the thing and thought through it, and I said, well, let's just give it a shot. And you know, and so we did, and we just got him approved at the preferred. Um, I mean, it just never came up the early part. It wasn't in any of those questions that Tom read, and he as well did real well on the agility test, the memory test. He's sharp as, you know, this guy was like 62 years old. We would have just told him a year ago or 2 years ago, you just can't get life long-term care insurance. Let's put it on your wife. So we're thrilled to help him. We had another person, a lady that had ovarian cancer like 8 years ago, and it hasn't recurred. She also has long COVID, and I don't know, a couple of other things that just weren't in those questions. She's like a yoga instructor herself after retirement. I mean, I just she passed the test with flying colors. We had a prostate cancer. I mean, I just could go on and on and on and on. So if you're one of those people who've been told that you can't get long-term care insurance, or you figured that out on your own, and you desire to have something to protect you to get these benefits, you know, and other than those states, and even if you're in one of those states, we've got some other annuity products available that have some easier underwriting. So give us a call.
I do want to make a point that this isn't just for people who have medical issues. Like if you really start studying these benefits, they're really pretty competitive anyways, even if we remove the underwriting benefits here. And so what this company done, what Equitrust has done, is they just have decided that the underwriting for traditional long-term care policies is sort of outdated, right? A lot of it is looking at your medical records. Well, if you have something in your medical records that might lead to an early death, which is, is certainly a possibility, Equitrust doesn't really care too much about that because they're worried about the long term care risk. And like Hans said earlier, the two sort of most common reasons people need long term care are going to be memory issues. That's probably the leading cause of needing care, or mobility issues, right? You just can't get around. You need someone to help you with that. So what Equitrust is doing is they're underwriting for those risks. And I mean, it's just a really cool policy that's available. And there's more nuances there. When you study the illustration, we could spend all day talking about how it all works. But if you're interested, call us and we'll walk through it with you specifically.
Yeah, and the other thing that I neglected to mention is this $100,000, if you bought this particular policy, is going to be deposited into the annuity, and it's going to earn interest. And there are going to be some charges for a long-term care premium out of that interest. But it's still going to accumulate and grow and build a cash value over time. And if you were to pass away before you need the long-term care, your beneficiaries are going to get paid out the cash value in this policy. Or if you needed to take some of that out for some reason, most people don't do this because they're compromising their long-term care benefits. But in any given year, you could take yourself 10% of that without a penalty. So the cash value, just like any other annuity, is there and is growing. Probably not real fast. It's not paying that high of a rate of interest, but you're not buying it for that. You're buying it for the long-term care benefits, and just know that there's a death benefit there to go to your beneficiaries in the event you don't use up the whole cash value for long-term care benefits. Now, there is no question that says right here, have you been rejected for long-term care insurance? So all the other annuities that we sell, and really all the other long-term care policies that we offer throughout the country, they have that question on there that says, have you been turned down for long-term care insurance by another company? Yes or no. And if you answer that yes, they won't take you. This product does not have that. So it's real obvious to me. That was the first thing I looked for when this thing came out. So that question is not on there. The indemnity benefit is very popular with most people. I mean, somebody that has a lot of money and they want to buy a large benefit, people that are wealthy, a lot of times they want to get care. They want to set up their own care. They want to get it in their home, perhaps hire somebody to move in with them, and they don't want to be they don't want all the trouble of having to work with the insurance company and work with the home health care agency to be sending in receipts and making sure everybody goes through the proper home health care agency. With the indemnity, if you stuck 200,000 in here and then you would double these benefits, that amount, like almost 12 grand a month, would come to you for 60 months tax free. And that's a pretty nice benefit to set up your own personal care plan where you don't have to prove it to the insurance company every month with receipts. The minimum that you can buy this with is 50 grand. Okay. So that's the smallest policy they'll sell. I believe the high end is 500 grand. And you need to be ages 55 to 80. And that's 80 in 364 days. So if we got somebody who is 80, but they're not quite 81, I actually had one of those that I quoted the other day, and I called the company. So that's the age range. The benefits are tax-free, the long-term care benefits, and that's under Section 7702B of the Internal Revenue Code. So you put 100 grand in, you wait several years, you start collecting the monthly amount for, and it's pretty soon you're going to get up into the 300 or 400 thousands of benefit paid out on your original 100 grand. I mean, normally you would have to pay taxes on those benefits coming out, but because they're coming as a long-term care benefit, they're tax-free. And you can add more premium in the first year. So if you want to use 50 grand to get one of these policies approved, once you get it, you can for 1 year, you can send in more money up to the company limits and get the same underwriting. So what I'd like to do is bring Tom back on, and we want to talk about really what we've touched on today in terms of holistic financial planning. I mean, I guess the first thing is we haven't really talked about Social Security. We haven't talked about Medicare. We've spent the whole meeting on long-term care. We have talked about 401k and IRA, because it would be nice if these companies, or this company, would allow us to use IRA money, but at this point we can't. So we've talked about income, because the annuity is designed to do that, and this is income to pay for long-term care. We talked about estate, because there is a beneficiary on this, and the unused portion of the policy at your death is going to go to your named beneficiary. And we have talked about taxes, because the benefits for long-term care coming out of this are tax-free. So with all of that, I'm Hans Scheil.
Tom Griffith.
And we thank you very much for listening.
Thank you.